We're going to welcome Jeff Hybiak, Chartered Financial Analyst from SEM Wealth Management. Jeff's a CFA. He received his Bachelor of Science degree in Business and Administration from the University of Northern Colorado. He's been a close personal friend of ours since 2010. We've had a relationship at Mason & Associates with SEM Wealth Management since 2010. SEM stands for Scientifically Engineered Models, which means as our sub-advisor and helping us manage our client portfolios, all of the decisions that we make in our client accounts are data-driven. They're not emotionally driven, which at this point in time, with everything going on in current events, it's important that we can rely on data rather than emotions, because if we're trading on emotions, we're really baseless in our decisions. So with that being said, Jeff, how you doing?
I'm doing great, John. Thanks for having me back. It's great first 40 minutes of the show. Very sound advice, and I think the main thing to drill home is that financial plan. It's tough to give advice without that financial plan as the foundation.
And Jeff, maybe you can just elaborate a little bit about what's going on right now. I know we've made a few tweaks in client portfolios recently, so maybe you can talk a little bit about how SEM is helping both Mason & Associates and your existing clients during this period of volatility and political unrest.
Yeah, absolutely. I think it's funny, not funny in the sense of, we're laughing if you're feeling angst about your investment accounts, whether you're a client of ours or just in a TSP plan or VRS or something like that. But if you go back with hindsight right now, the market peaked on January 6th. And there was a sense of panic when it started to look like the Federal Reserve was going to be raising interest rates at a much faster pace than everybody had anticipated going into the year. And one thing that we talked about in our fourth quarter newsletter was, look, we had a lot of great things going for us in 2021. Those are probably all going away in 2022. So right now everybody's focused on what's happening, with the tragic situation in the Ukraine. But the peak of the market so far was because people were afraid the economy was going too fast and the Federal Reserve was going to tap on the brakes. And so just looking at that, though, with that being the peak, right now we're down 12% on the S&P from the high. That happens on average once a year. A 15% correction happens about every 3.5 years, and we haven't had one since 2020. So the market was overdue and kind of just looking for an excuse to sell off. But inside of our models, to go back to what you alluded to, on January 10th, so 4 days after, with hindsight, the market peaked, our tactical bond model also started taking money off the table. It took about 40% of the money we had in high-yield bonds out. And then on January 24th, it took even more out. And by the first week of February, we were completely out of risky bonds on that. And so that's kind of the what I call the first line of defense for portfolios. Tommy mentioned the 60-40 portfolio. Well, that war chest is even stronger because we have that mechanism to sell before anybody even realizes it's time to sell. We had no idea why. Like you said, we're data-driven. We were concerned subjectively, but we waited for the data to tell us, hey, now it's time to sell.
Yeah, and Jeff, the data is really good, and sometimes we rotate out of growth stocks into value stocks, and we're not always going to be 100% right all the time, but we are following a system that's right more times than it's wrong. Am I correct?
Yeah, that's exactly right. I mean, a good system for us has a 60% winning percentage, which you look at the inverse of that, and that means we're wrong at least 40% of the time. But the key is discipline, in that if the system's wrong, and we even talked about that, our AmeriGuard models on Tuesday of last week, so 2 days before the invasion of Ukraine, sold. And then, of course, I forget how much the Dow was down on Thursday before it had that really great comeback. But again, before we even knew Russia was going to invade, it took some money off the table. And what's nice about it is, and we said it's going to happen, was if it's wrong, it'll just get back in. And if it's right, it's going to have that benefit. We already heard from some clients who looked at their accounts and said, hey, thank you for selling. I mean, in the whole scheme of things, it was 5 or 10% of their account. But they said, thank you for acting on my behalf without me having to do anything.
Well, it's like I said, and you were already tuned in and been listening to the show. We have the ability to do that. You know, as we were talking during the break, you folks could have an advisor out there that all they do is help people get, which is a really good mutual fund family, American funds. But if you had $100 million of your client's money at American funds, you couldn't possibly, make enough phone calls to get the confirmation from each client to say, even let's sell 5 or 10%, could you? So your only advice can be stay the course, hold what you've got.
Yeah, exactly. And there's a lot of other things, and you guys have done shows on that in the past, of the difference between commissions and fees and I was recruited out of college to go to that type of model. And the way they recruit you is you put them in and then you never have to talk to them again. So the fee model is in the best interest of people, and it suits all of our personalities, both at Mason and SEM, because we can act on behalf of all of our clients very quickly because we have been given that discretion.
And Jeff, I think, we have some listeners right now that have never met Mason and Associates before. They've never met you before. As we think about our relationship with SEM, us being 2 fee-only registered investment advisory firms working together to deliver massive value to our clients, I just am really excited that we get to focus on delivering massive value on the tax planning side, the financial planning side, the estate planning side, and then we get to use you and your team with your expertise to help do this day-to-day portfolio management, really select the best securities for our clients, make sure they're in the lowest cost shares of mutual funds, make those little tactical decisions to scale out of equities. It's not that we're not involved in the portfolio management, because we meet with you almost weekly to discuss what's going on in those accounts. But to me, and I think the entire Mason team as well as our clients, we feel really, really good about this relationship because you can't be all things to all people.
Yeah, that's exactly right. And the analogy we've used before is, if you have cancer, you're not going to go to a family practice doctor. You're going to want to get specialists that are involved and they're really good at the things they're good at. And you guys are the best at federal employees, Virginia employees, and figuring all that out. My mind just starts going in circles with all the rules that you guys have to know, but you have to dedicate your time to that. And when the market's going haywire like it is, we're at our trading desk watching it and making the moves when the models dictate to make the moves. And it would be virtually impossible for somebody to be an expert in TSP and VRS and successfully manage money in the market day in and day out. And so we chose to focus on what we're good at. My partner's an engineer. I was originally an accountant, and I like numbers, and that's my personality. That's what we chose to focus on and leave the financial planning to you guys.
It's an impossible task. We're going to make this statement, then we're going to come back. And Jeff, you need to stay on the line because you're going to stay with us till the end of the show. It's an impossible task for these people that call themselves wealth managers, to be pulling the trigger on all the investments and being that financial planner that understands your TSP, your VRS, your FERS. It's an impossible task. Here's what I want when you come back. I want you to think about this during the break. You said the S&P is down 12%, and it's March 1st. I would like to know, and I know what the number was, March 23rd of 2020, when the pandemic was, scaring us all to death. It seems like to me, and again, think about this, hit us on after the break. It seems like to me, S&P down 12%, fundamentals must be really, really strong as the world is in turmoil and the S&P's down 12%. I want to talk about that comparison to COVID, back in March of 2020. We'll be right back. This is the Mason and Associates Financial Planning Show, MasonLLC.net, MasonLLC.net.
You will rest easy once your plan is done. will see clearly just how you have won.
So the winning, and I don't mean to sound like the Orange Man, but winning, the win is you've spent an entire career building a great federal pension, private sector pension, saving for retirement. It's kind of crazy to go into that unknown world. Let me give you an example, and then Jeff's going to come back in. Again, I've been doing this 35 years. I'm much better now than I was 10 years ago, 20 years ago. But I remember Kramer on CNBC in March of 2009 making this statement: if you need your money in the next 12 months, this is not your market. Well, that would have been a great thing to say in March of 2008. But just before the market turned around and went up 50% before the end of the year, he makes that statement. And the statement is very important because it's not what he said, it's what's received. What a retiree receives is that if you're going to retire in the next 12 months, this is not your market. That's the most ridiculous thing because you're going to retire for 30 years. If you are going to need $100,000 for whatever purchase you're going to make in the next 12 months, well, you should not have had that money in the market in the first place. So media-based financial planners, no matter how much money CNBC pays to have Kramer on there, and I'm sure he didn't, John, mean to hurt anybody, but he has to understand the perception of what somebody hears when they say, if you need your money in the next 12 months.
Well, our song, "You're winning once you have your plan done," or "you're winning once you're working with a financial planning team," doesn't mean you're going to beat the S&P 500. It doesn't mean our portfolios are going to outperform. What it means is that you're going to have a track to run on, and you're going to have a financial plan that you can actually commit to. You're going to have a financial plan that you can act on, and you're going to be able to maintain your conviction in that plan. So that's how you win. What it means is that if you're just tuning in, you have to have some money in your war chest. And in 2008 to 2013, that crisis took about 5 years to get back to whole, from peak to trough, back to even again. So if you have 5 years in a war chest, which is cash and fixed income, Jim Cramer's message could have been received a whole lot differently if we had a comprehensive financial plan that can put all of this into perspective. So that message was taken out of context. That message was without base, was without any sort of foundation for people's financial plans. So this just takes us back, if you're tuning in, and we have a few more questions and statements with Jeff. But during times of volatility, if your financial planner, in quotations, is giving you the advice that you should not look at your statements and go have a glass of wine or ignore the current volatility, that's not a plan. What we do at Mason & Associates is we embrace the volatility because, one, it was expected. Two, like you've heard from SEM and how we manage our client portfolios, is that they're mechanical and the trades and the allocations are based on data. But we're also not going to stick our head in the sand. We're actually going to look for opportunities, whether it's rebalancing, tax loss harvesting, Roth conversions, and more. The advice is not ignore it. The advice is embrace it, because if we embrace the up, we have to embrace the down, and we have to look for opportunities on both sides. So, Jeff, are you still there?
Yep, I am.
Awesome, man. So Mike teed you up pretty good. He said fundamentals are good. I'll paraphrase. I'm actually surprised the market's not down more with all the political unrest that's going on. So the underlying fundamentals in the market must be pretty good, that we haven't seen extreme volatility. So with that, we'd love to hear your thoughts.
Yeah, I mean, I've used to do fundamental stuff, and I got burned on that in the 90s, and so I'm not going to talk too much of it. But yeah, it's very impressive. Only down 12%. Looking back, March 1st, 2020. So that's just when people were starting to get worried about COVID. By the way, just like this year, that's when our tactical bond was already sitting in cash. So before the panic, which really I marked the panic as March 13th. That's the day the NBA shut down. That's when people really started paying attention. But we were at 2,800 on the S&P March 1st, 2020, so 2 years ago. So we're up 53%, even after this 12% drop. And, it is due. It's overdue. We talked about it going into the beginning of the year. All the things that were in our favor in 2021, stimulus, the Federal Reserve, people opening up, that's going to go away. The market moves in cycles. And that just goes to what you're saying is a planner doesn't say just have a glass of wine and don't look at your accounts. A planner says we are ready for the inevitable, whether it's a 20%, 30%, or even 40% correction. We're planning for it, and we have mechanisms in place. And I think that's for the people who don't work with a good financial planner. We saw this with their TSP accounts and VRS accounts. They jumped into the markets too high in October, and you're only down 12%. So if you are over allocated to stocks, there's still a chance to get out. If you're under allocated to stocks, we saw people panic and say, for whatever XYZ reason, I don't want to be in the market. Well, now stocks are 12% off of what they were just on January 6th. So we can't give blanket advice like Kramer, or it's just frustrating on CNBC to see all these people giving predictions about what's going to happen in Ukraine. Nobody knows. That's what I'm never a guest on CNBC because I'm not going to, get ratings by saying, look, nobody really knows, so there's no point in guessing. And, we can't give advice to people without knowing what their financial situation is.
Yeah, thanks, Jeff. As I think about it, kind of what you said there, many great statements, but one of the things that resonates with me is, and I'll paraphrase it, is having that plan in place allows us to stick with the plan as we go through these expected moments of volatility. We don't necessarily know when they're going to come. We've got investment strategies in place. We have a plan in place to allow us to stick with a long-term strategy. And also, when I think about some of the opportunities that your team's able to take advantage for us when we get these moments and times, is I know that you guys are doing that tax loss harvesting for our clients.
Yeah, we've been able to every week almost. And it's going to pay off because we're sitting on these losses that can offset gains, going forward.
This is the way it's supposed to be done. You handle your end of this. We're handling the financial planning end. Our clients are better positioned for this downturn than most folks. Most folks, you've got pensions. Remember, you're a millionaire in your defined benefit pension, and guess what doesn't happen? When the market goes down 12%, your pension doesn't go down 12%. So you're better positioned for this than most folks. Jeff, we appreciate everything you do for us. I know our clients do. Let me just say this to our clients. Having a glass of wine is not a bad thing, John. Here's what I want you to do. I want you to look at your statements. I want you to look at your financial plan. I want you to schedule your strategic planning meeting and then sit down and have a glass of wine, because you will rest easy that your plan is done. This is Mason and Associates, Mason, LLC.